U.S. negotiators are heading to China on Monday to resume discussions over trade concerns. That may include the Huawei ban. I sat down exclusively with Huawei CEO Ren Zhengfei last week to talk to him about the company being caught right in the middle of these negotiations. Take a listen.
The
trade between China and the U.S. has nothing to do with us. We barely sell anything to the United States. When the two fight, I don't buy from the U.S. Even if the U.S. wins, I still don't go there. So we have nothing to do with the tension between China and the U.S.
The resumption of those trade talks comes as investors await the FOMC meeting next week. We've got Tom Lee here. He is the managing partner and head of research at Fundstrat Global Advisors. And Tom, it's interesting to see the market reaction yesterday when we heard where Bloomberg reported that U.S. negotiators were heading back to Beijing. We kind of went through a period where investors shrugged off any trade headline, and yet we saw a bit of a move there. Are they suddenly back in, are we seeing the market suddenly move back on trade?
I think the market was sort of building towards a consensus view that some correction was going to take place. It's been acting tired. Earnings weren't going to be great. I think a lot of our clients were also wondering if the Fed move at the end of this month would have any impact. So I think people were tilting towards being cautious. And I think yesterday's reminder that, number one, investors' positioning is not that bullish. But secondly, I think even from the earnings and the movements we've seen in the semis, that whole late cycle narrative is really not as strong as maybe more the economy's mid-cycle.
Let's talk about the Fed, because we've got that meeting coming up next week. And you've talked about the Fed having a dramatic impact on markets. I mean, the thinking being that even if the cut is 25 basis points, we could see a huge move to the upside.
Yes. Number one, I think it's coming at an appropriate time because it's really acting as insurance. We've studied past Fed cuts, and as long as the LEIs, or leading economic indicators, are positive, it has a huge effect. But at the moment, there is some funky things happening in the credit markets that I think a Fed cut would really ease.
Like?
Well, one of the things, obviously, is the prevalence of negative debt elsewhere. So we know that there is a lot of risk aversion taking place. But some of our clients have also pointed out that when you look at the spread between Fed funds and interest on excess reserves, they've really diverged. And the IOER was supposed to be the ceiling for the Fed funds. Fed funds are trading through that right now. So I do think the market needs some sort of easing or QE or Fed cut.
So let's assume that the Fed cut is the catalyst. You say expect stocks to rise into year end with 3,125 target that you have right now is low. How much higher can it go?
Well, 3125 would only represent less than 5% upside from this in the second half. If you look at past Fed moves, just in the first 6 months, the median gains around 13%. So I think a 10% move is appropriate. We think the ISM, which is bottoming in the third quarter, is going to start to turn up in the final 3 months of the year. That's a cyclically expanding, bullish cyclical signal. So I think PE expands. I think 3,300 is probably more realistic.
So how do you think investors position themselves in anticipation of that cut and that being the catalyst to push things higher?
Well, I think the cue that they should take from just this week alone is the fact that the semis are making all-time highs. If you look at the past equity market cycles, semis rolled over months and months before the market topped. If we're talking about all-time highs in semis, that's super bullish. And so I think people need to be cyclical, maybe more quality growth, but that's a lot of tech. Instantly, we write about equity TINA. There's no alternative. Stock cash return yields in the U.S. are still higher than Europe, Japan, EM.
You've also talked about large cap versus small, being that investors should put their money in large caps in anticipation of the Fed move. And yet the argument, if you look at the trade side, has been that small caps are the ones that protect you from any trade headwinds. How do you balance those two?
I'm really sympathetic to the idea that small caps need to show some relative performance. But what we wrote about last week was it looks like there's maybe a larger cycle at work where small caps are just going to be in a structural downturn relative to large caps. And it has nothing to do with financial liquidity or valuation, but it's more a preference that as people think about TINA, equity TINA, they're going to buy U.S. large cap.
Okay, we'll have to leave it there. Tom, I appreciate your time
Great,
today.
thanks.
Tom Lee joining us from Fundstrat.